Hello friends, once again welcome back to the show. Following my last video regarding the new proposal from PSCL regarding transfer of our maintenance deposits, I have received some very enlightening and insightful inputs. So let us take a look at these ideas and develop an appropriate plan that suits the best interests of the society. The first question that comes to our mind is, how does PSCL plan to maintain the price line? How is it that they can guarantee us a fixed TMC at the rate of 1 rupee per square foot per month for a period of 14 years? We have seen earlier that it would take 14 years at least to come to a zero balance state. Now, one way to address this problem would be to provide an exit clause, say after 5 years. This way, we can also have the opportunity of getting our deposit back. That means the balance of the deposit that remains, because after all, PSCL does not envisage that they will stay in the same state financially. In their personal conversations or across the table, they said that they are going to face difficulties till the end of 2025. If we set a horizon of 5 years, then we can review the process and have an opportunity of exiting this arrangement, taking back the deposits, and also reviewing the interest rate or the TMC rate. This gives an opportunity to all of us to review and to move forward. The next question that arises is regarding GST rate change. Ever since the GST was introduced, there have been many changes to the rate at which GST is levied for various services. So we don't know what the future holds for us. This can be easily overcome if the GST is directly collected from the individual member and not from the corpus. This gives the freedom to adjust for any GST change that occurs. The next thing is, with this arrangement, there will be no compliance burden of GST on the society, because each member will be paying the GST directly every year based on the rate which is prevalent at that time. However, it will be seen that since the GST has been taken out of the corpus contribution towards the TMC, the period to zero balance will increase to almost 20 years. I will show you those sheets in a snapshot shortly, and also you will find a link to the workbook for the revised rates. Once again, the exit clause and a time-limited TMA which was suggested in the earlier slide will come in handy to overcome such changes and make the arrangement more flexible and less rigid. Another question that arises is that what happens to the income tax that could be levied to the society? Because even if it is not shown in the books, essentially the 8.5% interest that is earned is a notional income to the society, and PSCL is bound to cut TDS on that. How to overcome this situation and make accounting simpler? The solution actually is quite simple. PSCL can deduct the TDS from each individual member, and for that they will have to have an increased burden of filing Form 26A for every individual member. This will increase their workload, but of course the society can compensate them with a nominal compensation of about 50 rupees or 100 rupees per member per year to do the necessary paperwork. This will overcome the problem of getting the society involved as far as income tax and TDS is concerned. The society will have no burden of income tax and have no liability whatsoever. The next question that needs to be addressed is, what about Section 70 of the MCS Act? According to this section, a cooperative society cannot invest or deposit its funds with a company like PSCL or AHPL. So what do we do if this money is to remain with them? So long as the deposit of 1.32 crores does not come to the society's account, it remains as an individual member's deposit which was collected at the time of possession. Due to financial constraints, the builder or the project proponent is unable to transfer this amount to the society's account. So it is still not in the society's account. And it is for this reason that we have devised a methodology that the TDS filing will be done for each individual member against their individual PAN numbers. The PAN number of each flat owner is clearly mentioned in the Index 2. Let us now take a look at an example of a 1 BHK flat measuring 426 square foot carpet area with an interest rate return of 8.5% and a TMC rate of 1 rupee per square foot of carpet area per month. The annual TMC for this comes to 5,112 rupees. This is excluding the GST, and we shall just see how this works out. This is the revised Excel sheet for the 1 BHK flat measuring 426 square feet. As you will see, the first 5 columns are the same as the previous example, which constitute the period, the deposit for each individual, which is the same, 49,624, the interest that accrues on it at the rate of 8.5%, which comes to 4,218 in the first year, so that the total funds available for use as TMC is 53,842. Let us now take a look at the next column. This is the TMC excluding GST, which is simply a multiplication of the carpet floor area with 1 rupee and 12 months, which comes to 5,112 rupees. This is TMC excluding GST. Now what we have done is that we are going to take a contribution from the corpus, which is shown in this column. In the earlier example, we had taken a corpus deduction of 6,000. This has now been reduced to 5,000. The next column, H, shown after this one, shows the TDS, which is a 10% deduction on the total earning. As you can see that the earning of interest on the deposit was 4,218, and that works out to 422 rupees rounded to the nearest integral number. Thus you will see that an individual will contribute as shown in this column. Every year's contribution will come to 112 rupees, which is the difference between column F, which is TMC excluding GST, and the corpus contribution of 5,000 rupees. What is new is the next column, which is the GST column. Now this GST will be 922 rupees calculated at 18% of the amount which is to be charged for TMC as shown in column F. Thus you will see that column K shows what the member pays every year for this 1 BHK 426 square foot flat, which is equal to 1,032 rupees, which is the sum of I and J. Now after deducting the corpus contribution of 5,000, which is shown in G, from the total amount which was shown in column E, what we are left with is the balance which will be carried forward in the next year. The first year's balance is 48,420 rupees, and this is how you start the following year. This keeps on going, and it takes, as you will see, 20 years to reach a zero balance state. Now that is a very long period, and in order to overcome such long periods of time which bring in such inconsistencies and variables such as rate change of GST, rate change of bank interests, etc., and the constancy of TMC to beat the inflation, a better way out would be to have an exit clause after, say, 5 years. For the purposes of illustration, I will now present the Excel sheet for a 2 BHK 833 square feet apartment. The interest rate remains the same at the rate of 8.5% per annum. The TMC rate shown is also 1 rupee per square foot of carpet area per month, and the annual TMC works out to 9,996. The next sheet that follows explains how it works. This is what the Excel sheet looks like for the 2 BHK 833 square foot apartment. You can examine, explore and study this in the Excel sheet itself, which can be accessed with the link provided in the description box. Once again, at the end of 20 years, you will reach the zero balance state. As will be evidenced if you look at the bottom of column D, the last entry below the 20th year is 52,226 rupees. This is the total interest that will be paid by PSCL over the course of 20 years on an initial deposit of 49,624. So I don't think PSCL would like to find itself in this situation where they are paying such a heavy interest for such a long period of time. They would definitely like to have an exit clause somewhere around the 5th year or so after their financial situation improves. And we also benefit because we'll be able to get a sizable chunk of our money back. What you can see on the screen now is the revised TMC calculation per flat for every type of flat in the building, and you will see that this is what the member pays. The TMC to be collected after the contribution of corpus will be 112 rupees for a 1 BHK 426 square foot flat, and the GST payable will be on the total amount of the TMC of 5,112 rupees, and that will turn out to be 1,032 for this particular example. So you can go through each one of these carefully, and you can also download the Excel sheet from the link provided in the description box. So friends, that brings me to the end of this presentation. I shall now provide a summary of the salient features. We saw how we can address concerns about inflation, how we can introduce an exit clause and have a time limited agreement, say for about 5 years, which gives the opportunity to the builder to refund the balance amount which remains after paying for the TMC for 5 years. Next, we also saw how we can overcome GST rate changes and issues relating to income tax. We also saw that with the arrangement that has been presented today, we will not be violating Section 70 of the MCS Act. I have also provided new revised calculations for each flats, which you can pause and read on the screen, or you can download the Excel workbook from the link provided in the description box. So thank you once again, dear friends, for your attention, and till we meet again, bye bye. Thank you.